So everybody, welcome to our cash part 3. Here's the theory behind bank reconciliations. Okay, we're almost there. Why do we do bank reconciliations? Do banks make mistakes? Oh, yes, they do. This is one of my favorite ones. Do banks sometimes open up multiple accounts without us knowing? And the answer to that is also going to be yes. If I look over here, oh, Wells Fargo, fake account scandal, right? So Wells Fargo is just seen to be hitting things left and right. You can hear phone calls, and I was listening to talk radio in the afternoon one day, and somebody gone on about the pressure that these guys were under to open up accounts. So this is definitely something that happened, and they got in big trouble for it. And I think it's kind of destroyed their brand. But in any ways, why do we do bank recs? Banks make mistakes. Will employees make mistakes when recording transactions? Yes, we are all human. Now, at the same time, there might be, if I'm downloading everything or if everything's electronic, I may lessen those mistakes, but at the same time, I still have to verify that things were appropriately recorded. This is also probably the most important part of bank reconciliations. It is giving us an opportunity to compare our internal books and records to an external source. This is so important. And it's essentially verifying what we go through and do. I can tell you from my own experience, I've walked into organizations and I asked, well, when was the last bank rec done? They said it was 6 months. That CFO/controller was no longer with the organization a short time thereafter. So what you have to understand is that when you're looking at bank recs, when you're looking at these different types of things, it's something that it's a very important part of going through and doing it. So what are we going to do in a bank rec? We're going to take the bank balance and we're going to compare it to the book balance. We're then going to go through and make adjustments to the bank and adjustments to the book. And this is going to give us our adjusted balance. The last step we're going to go through and do is we're going to essentially record on our books those adjustments to the books. So what are the adjustments to the banks? Well, if we've written checks on our books, but those checks have not yet cleared the bank, this is going to decrease our bank balance, right? So this adjustment to the bank is really talking about over here is this part here is the adjustments to the bank. The next one for the adjustment to the bank is a deposit in transit. I've made a deposit that has not yet cleared the bank. This is going to add to my bank balance. Remember, what we're trying to go through and do is to show that our adjusted bank balance is equal to our adjusted book balance. If I've shown a check that has not cleared, I have to deduct this from the bank because it should clear. If I have a deposit that should clear, I have to show this as a deposit that's about to clear. So again, those are why I'm adjusting this for the bank. Now, a bank error. If the bank gave us money or they took money out of our account that should not have been done, in this case right over here, what I'm going to go through and do is this is what we would call a bank error. And all I'm going to go ahead and do is just adjust the bank balance, and I will call the bank to make sure that that error is corrected. Okay, what's really important is we're going to adjust the bank balance to equal our book balance, but we are never going to make journal entries for those bank adjustments. So for outstanding checks, deposits in transit, and bank errors, we will never make journal entries because these are really the purpose of these is really to reconcile that external statement so it matches what we have internally. Okay, adjustments to the books. You've got interest revenue. If the bank statement shows that we earned revenue or we had interest income, we're going to show that as interest earned on our books, right? And this is going to be an increase to our cash balance on the books. Lockbox collection. If the bank has collected money on our behalf, this is going to show as an increase to our book balance. Bank service charges. If the bank is charging us a fee for keeping our checking account open, that's going to show as a deduction on our book balance, right? The bank charged us an amount that was legitimate. I have to show that as a decrease to our book balance. Return checks. If we try to deposit a check and the bank said to us, non-sufficient funds, right? Or if they rejected a credit card receipt, right? This is something that's going to show as a decrease to the book balance. This is one of the ones that's trickier for students because we have to do something called reinstating the accounts receivable. Book errors. If the bank showed something correct, but we showed it as incorrect, we're going to have to go through and adjust our book balance. So most important thing is our book balances are always made against cash. So if I have a return non-sufficient funds check, I'm going to be debiting accounts receivable, crediting cash. If I have a interest report in my bank statement, debit cash, my cash is going up, I'm going to credit interest revenue. If I have a bank service charge, debiting bank fees, I'm crediting cash. Book errors could go either way. Bank collections of notes, I'm debiting cash, and I'm going to be crediting notes receivable or accounts receivable. If you're having troubles with debits and credits, please take a look at some of my prior videos that are in the shortened series, and hopefully those will help you out. I want to thank you here today. Please leave any kind of questions you might have below, and appreciate you liking and subscribing to the channel. I look forward to seeing you on the next video. Have a great day.